Usually, when we look at a corporate turnaround, there is this underlying expectation of just, a slow, grueling, painful grind.
Oh, absolutely.
It's that classic analogy of trying to turn an aircraft carrier in a bathtub, right?
Yeah, taking years.
Exactly. You make a tiny adjustment to the rudder, you wait, 3 years, you burn through billions of dollars in restructuring costs, and maybe, just maybe, the financials start looking a little less grim.
Yeah, it's supposed to be this waiting game that tests the patience of even like the most hardened value investors.
But then you look at Intel's Q2 2026 earnings call, and it's like someone strapped a Saturn V rocket to the hull of that aircraft carrier.
That's a great way to put it.
We are looking at a quarter that completely shatters the Wall Street physics of how fast a company this massive can actually pivot. Welcome to Talk Tickers, the deep dive where we break down corporate earnings for you, the retail investor.
And the sheer gravitational pull of this AI supercycle it's warping the timeline of traditional corporate restructuring.
It really is. So our mission today is to strip away the corporate fluff from ticker symbol INTC and deliver a, fast-paced, data-forward, plain language analysis of whether the stock is a buy, a hold, or a fold.
Because if we strip away the PR spin and the standard, management optimism, the raw data from this quarter is just startling.
So let's jump right into it. Part one, the headline numbers.
Right, because finding an extra $1.8 billion in revenue within a single 90-day window isn't just an accounting anomaly or a lucky break.
No, definitely not.
It points to a fundamentally mispriced demand curve. I mean, the internal forecasters at Intel, these are people who model global silicon consumption for a living, they completely missed the reality of the market. And they missed it to the upside.
Which is wild. Let's look at those exact numbers. So Q2 revenue came in at $16.1 billion.
Okay.
That is $1.8 billion above the midpoint of their own guidance from just 3 months ago.
A massive beat.
But what really jumped off the page for me wasn't just the top line revenue, it was the profitability. Like non-GAAP gross margin hit 41%.
Which is huge. They beat guidance by 280 basis points there.
Exactly. And their non-GAAP earnings per share came in at 42 cents, which is more than double the 20 cents they had projected.
Yeah. And the mechanics behind that margin expansion are what make the semiconductor industry so fascinating to me and honestly so volatile.
Let's translate that for the listener because, 280 basis points sounds like Wall Street jargon.
Right. So 280 basis points just means their profit margin was 2.8% better than they promised.
Okay.
And when you apply that to $16.1 billion in sales, you are watching hundreds of millions of dollars in unexpected, just pure gross profit drop straight to the bottom line.
Wow.
This is the raw power of operating leverage in a semiconductor fabrication plant or, a fab.
Because the fixed costs are so astronomically high to begin with, right?
Exactly.
I always imagine building a fab is it's like building a hyper-advanced, multi-billion-dollar restaurant.
Yeah, that's a perfect analogy.
Like the rent, the ovens, and the specialized chefs cost an absolute fortune. But once you sell enough meals to cover those fixed costs, the actual ingredients for the next, 1,000 meals cost you almost nothing.
Right. The profit on every plate after break even is nearly 100%.
Yeah, so it captures that dynamic perfectly.
A modern semiconductor fab costs upwards of $15 to $20 billion just to build and equip. I mean, the depreciation on the extreme ultraviolet lithography machines alone is just a massive anchor on the balance sheet.
Right. Those EUV machines are not cheap.
No, they're not.
Yeah.
But once you cover that baseline utilization rate, the variable cost of pushing one more silicon wafer through the line is relatively tiny.
So when Intel beat their revenue guidance by $1.8 billion, that wasn't low margin revenue.
Exactly. That was incremental revenue running through fully depreciated, highly utilized factories. Every extra chip they sold was disproportionately profitable.
And that operating leverage is the sole reason their earnings per share doubled, while their revenue only beat by about 12%.
Precisely.
Which, raises the immediate red flag for any skeptical investor listening to this deep dive.
Sure.
Because if a company beats earnings simply because prices spiked temporarily, or say a competitor had a factory fire.
Yeah, you can't model that out into the future. That's a one-off.
Right. So looking at the data, I have to ask, is this just a lucky quarter driven by temporary macro conditions, or has Intel fundamentally altered its operating cadence?
The data points to a systemic shift in how the company operates, actually.
Really?
Yeah. CEO Lipu Tan explicitly noted that this marks the 7th consecutive quarter Intel has exceeded financial expectations.
7 quarters. That's almost 2 years.
Nearly 2 full years, yeah. And in the semiconductor industry, 2 years is a complete product cycle.
Wow.
You cannot fake 7 quarters of beats through temporary price spikes. It requires a real structural change in operating discipline, supply chain management, and yield optimization on the factory floor.
Okay, so let's get into part 2, the story behind these numbers. The mechanisms of that demand, because the numbers themselves are just kind of the exhaust fumes.
Right, what's the actual engine?
Yeah, the real engine here, the force driving that 16.1 billion, is artificial intelligence. But the specific way AI is impacting Intel completely flips the script on what the market believed just, 24 months ago.
Oh, totally. The call stated that Intel's AI-driven businesses grew greater than 70% year over year.
Which is insane. AI now makes up roughly 70% of total revenue.
Yeah. If you look at the data center and AI group DCAI, they pulled in $6.3 billion. That is up 59% year over year.
Wait. For the last 3 years, the dominant narrative was that standard server CPUs were dead.
Right.
Everyone believed that NVIDIA and their massive GPU clusters were just eating the entire data center budget. So why are Intel's traditional Xeon 6 processors suddenly flying off the shelves?
Well, we are witnessing the evolution of AI architecture in real time. The narrative you mentioned was perfectly accurate for the training phase of the AI boom.
Okay, so like the early stages.
Exactly. When you are training a massive large language model, you're feeding it trillions of parameters.
Yeah.
That requires brute force parallel processing, which is exactly what a GPU is designed to do.
Right. GPUs are essentially thousands of tiny, relatively simple calculators working simultaneously, right?
Yeah, crunching the massive data sets to build the underlying neural network. But the industry is rapidly transitioning from building the models to actually using them. We are moving into inference and, more specifically, something called agentic AI.
Agentic AI. Let's break that down for the listeners.
So agentic AI doesn't just passively generate text like a chatbot. It takes agency. It performs multi-step tasks across different software environments.
Can you give an example of that?
Sure. Imagine an AI agent tasked with auditing a company's travel expenses. It has to securely query the HR database, log into the corporate card portal, cross-reference receipts,
apply logic-based company policies, and then generate a report. That is sequential logic. That requires navigating complex, highly secure enterprise software, not just, guessing the next word in a sentence.
And that sequential logic, that highly secure database querying, is exactly what an x86 server CPU like a Xeon processor is built for.
I see.
The CPU acts as a central nervous system. The GPU might do the heavy pattern recognition, but the CPU actually executes the tasks and interfaces with the rest of the world.
So Lipu Tan noted that as AI becomes more agentic, the ratio of CPUs to GPUs in the data center is moving back toward parity.
Right. We are moving away from pure GPU clusters to heterogeneous clusters, where you need powerful CPUs to feed data to the GPUs and execute the resulting logic.
So the pie is getting bigger, and the CPU slice is expanding within that bigger pie.
Exactly.
And it's not just volume, right? Because they are selling these Xeon 6 chips at significantly higher average selling prices.
Yeah, ASPs are way up. They successfully passed inflation costs onto the hyperscalers and sold a richer mix of chips with incredibly high core counts.
But why are hyperscalers willing to pay those higher average selling prices?
Because power consumption is now the ultimate bottleneck in a data center. A higher-end CPU with more cores might cost more upfront, but it requires less physical footprint and less cooling per computation than stringing together a bunch of multiple cheaper CPUs.
Right. So total cost of ownership is the only metric that matters to a cloud provider right now.
Exactly.
Well, that perfectly explains the surge in the data center, but what about the edge?
Right. The edge is fascinating.
Yeah, Intel's client computing and physical AI group, CCPG, they brought in $8.9 billion. And they completely rebranded the segment to include physical AI.
Yeah, they did.
And the sleeper hit inside those numbers is edge deployments. They noted that edge deployments now make up 10% of their client revenue. What is driving $1 billion a quarter in edge computing?
So the edge is really about physical proximity.
Yeah.
It is computing that happens locally, right, where the data is generated, rather than sending that data back to a centralized cloud. The mechanisms driving this are latency, bandwidth, and privacy. Consider a robotic arm on a high-speed automotive assembly line.
Okay, I'm picturing it.
It's using computer vision to weld parts. If that robot detects a flaw, it needs to adjust its weld in, like, 5 milliseconds.
Right. You literally cannot send a 4K video feed to a data center in Virginia, process it, and send the instruction back to the factory floor in Michigan in 5 milliseconds.
No, it's impossible.
Speed of light and network routing just, make it impossible.
Exactly the issue. So you need server-class compute power sitting on the robot itself. That is edge computing.
Oh, okay.
Intel actually announced 130 specific design wins for edge AI applications this quarter, heavily focused on brain and control deployments for robotics, smart retail, and autonomous logistics.
So they are taking their high-performance PC architecture and essentially embedding it into the physical infrastructure of the economy.
Exactly.
Okay, so the demand side of the equation is on fire data center, PCs, and edge. But, a semiconductor company is only as good as its manufacturing base.
Right, the foundry.
Which brings us to Intel Foundry, which reported $5.8 billion in revenue. And this is where the turnaround shifts from just a financial narrative to a hardcore engineering reality.
Oh, absolutely.
The Foundry reported that their 18A node output was 25% above their internal target.
And to understand the magnitude of that 25% yield improvement, you kind of have to look at the physics of what they are actually building.
Let's do it.
For years, Intel really struggled with their 10 nanometer process because they delayed adopting extreme ultraviolet or EUV lithography.
Right, the multi-patterning issue.
Yeah, they tried to use older machines with multi-patterning, which basically meant running the silicon wafer through the machine 3 or 4 times to draw the tiny lines.
And every pass increased the chance of a microscopic defect, which just destroyed their yields.
Exact.
I always think of it like trying to paint a masterpiece with a roller brush by going over the same spot a dozen times.
Yeah.
Eventually it just smears.
It does. But with the 18A node, Intel has not only fully embraced EUV, they are deploying 2 radical new technologies simultaneously, RibbonFET and PowerVia.
Okay, break those down for the listener.
Sure. So RibbonFET is their version of a gate-all-around transistor. As transistors shrink to the atomic level, electrons tend to leak out, which wastes power and creates heat.
Bad news for a tiny chip.
Right. RibbonFET wraps the gate around the transistor channel on all 4 sides, completely shutting off that leakage.
Okay, and PowerVia is their backside power delivery network, right?
Yes. Traditionally, the microscopic power lines and the data signal lines were all woven together on the top of the silicon chip in this incredibly chaotic, multi-layer traffic jam.
Oh, I see.
PowerVia moves all the power lines to the back of the silicon wafer.
Yeah.
It separates the power from the data.
Oh, I see.
This dramatically cleans up the signal routing and reduces resistance. The reason their yields are 25% above target is because these 2 technologies, which, many thought were too risky to implement at the same time.
They're actually working synergistically.
Exactly. They are manufacturing these chips cleaner, faster, and with far fewer defects than their most optimistic internal models predicted.
And the financial impact of fixing that physics problem is staggering. CFO David Zinsner stated that because the 18A node is performing so well, they have driven down the cost of manufacturing their primary Panther Lake processor by roughly 50% year to date.
Yeah, cutting the manufacturing cost of a flagship product in half in 6 months is insane.
It really is. But wait, if their factories are running 25% above target, the bottleneck can't be printing the silicon.
No.
Yet, Lipu Tan said point blank, the industry is facing one of the most severe supply constraints in its history. We have surging demand and factories humming better than ever. Why can't Intel just ship more product?
Because a raw silicon wafer is completely useless until it is packaged. The bottleneck has shifted downstream.
Downstream.
Yeah. Intel is not constrained by their ability to print logic wafers. They are severely constrained by advanced substrates and high bandwidth memory, or HBM.
This is where we need to explain advanced packaging, specifically EMIBT, because it completely changes what a computer chip actually is. We need to stop thinking of a chip as a single flat piece of silicon.
It is the difference between suburban sprawl and urban density.
I like that.
For decades, the industry relied on monolithic chips. If you needed more processing power, you just made the silicon die larger. But there is a physical limit to how large you can make a single chip before manufacturing defects make it economically unviable.
So the industry shifted to chiplets.
Right. They print smaller, individual pieces of silicon, one for logic, one for memory, one for input-output.
But then you have to connect them, and the speed at which they talk to each other becomes the new bottleneck.
That is where the substrate and the packaging come in. You can't just wire them together with copper on a green circuit board. That's way too slow.
Okay, so what does Intel use?
Intel uses EMIB-T, which stands for Embedded Multi-Die Interconnect Bridge. They embed microscopic silicon bridges directly into the organic substrate below the chiplets. Instead of a sprawling ranch house, they are building vertical skyscrapers. And EMIB acts as the ultra-high-speed subway system connecting the different towers.
It allows massive amounts of data to flow between the logic chiplet and the memory chiplet at incredibly low power. But manufacturing those incredibly complex microscopic substrates is just as difficult as printing the transistor itself.
And the global capacity for advanced substrates is completely tapped out. Every major AI chip designer in the world is fighting for substrate capacity.
Yeah.
Furthermore, getting enough high bandwidth memory to stack on top of these logic chips is equally constrained. Zinsner noted that their ability to supply the market is dictated not by their internal wafer production, but by their ability to procure external memory and substrates to finish the packaging process.
Which is the core irony of the quarter, really. But securing those substrates and building out that packaging capacity doesn't just happen because Intel asked nicely.
No, it does not.
It requires an astronomical amount of cash. Which brings us to part 3. Management's guidance and the massive CapEx bet.
The $20 billion elephant in the room.
Exactly. Looking at the Q3 forecast, they are guiding for a midpoint revenue of $16.3 billion. Gross margins are holding strong at 42%, with 38 cents in EPS. However, there is a clear macroeconomic headwind in the PC market that we just cannot ignore.
Right.
Zinsner warned that PC consumption will be sub-seasonal in the second half of 2026, likely down low double digits for the year.
And the irony there is that the PC slump is directly caused by the AI boom in the data center.
How so?
Well, the hyperscalers are consuming so much global memory capacity for their AI servers that the baseline price of memory is skyrocketing.
I see.
PC manufacturers who operate on razor-thin hardware margins anyway are getting crushed by these component costs.
Yeah.
They literally cannot build affordable consumer laptops with enough memory to run local AI workloads with us destroying their own profit margins.
So they are pulling back on production, which directly impacts Intel's client revenue. During the Q&A, Stacy Rasgon from Bernstein pushed management on exactly this. If your primary volume driver, the PC market, is contracting, what do you do with all that factory capacity?
Yeah, that was a great question.
And Zinsner's response was incredibly telling about their current market position.
He essentially framed the PC slump as a strategic relief valve.
A relief valve?
Yeah, because Intel is so severely backlogged on server CPUs and custom silicon for the data center, they are actively shifting wafer allocations away from standard PC chips.
Oh, wow.
They're redirecting that factory capacity to the highly profitable, supply-constrained server products. They have the flexibility to absorb a PC market contraction by just building a different, more profitable product line that already has a line of customers waiting out the door.
But just shifting wafer allocations internally isn't enough to meet the long-term AI demand. And this is where traditional value investors start hyperventilating.
Right, the CapEx.
Intel is raising their 2026 capital expenditure to over $20 billion and signaling that 2027 will be significantly above that.
Yeah.
Spending $20 billion on physical assets while your highest volume market is slumping is terrifying. That is the equivalent of building an addition on your house that costs more than the house itself.
It sounds bad on paper, for sure.
Why shouldn't an investor look at this capital intensity and just run for the hills?
Because you have to evaluate capital expenditure through the lens of liquidity, subsidies, and demand visibility. If they were taking on $20 billion in toxic debt to build factories on speculation, it would be a massive red flag.
Obviously, yeah.
But the liquidity profile here is pristine. Zinsner detailed $30 billion in cash and short-term investments on the balance sheet, plus a $10 billion revolving credit facility that remains entirely undrawn.
So that's $40 billion in immediate, frictionless liquidity.
Right. They also highlighted roughly $10 billion in non-core equity assets that could be monetized tomorrow if the macro environment deteriorated.
Okay, so the balance sheet is a fortress. They are not going bankrupt funding this build-out. But even if you have the cash, spending $20 billion is a massive drag on free cash flow. How does the CHIPS Act actually change the math on this investment?
It structurally alters the return on invested capital. Zinsner spent significant time outlining the gross to net dynamic of their capital spend, specifically citing the Advanced Manufacturing Investment Credit, or AMS, provided by the U.S. government.
Okay, how does AMA work?
For every dollar Intel spends building a fab or buying manufacturing equipment on U.S. soil, they get 35 cents back as a direct tax credit.
35 cents on the dollar.
Yeah,
That means a $15 billion cutting-edge fab effectively costs them less than $10 billion.
exactly. And over a decade of depreciation, that dramatically lowers the break-even point for every wafer produced in that facility. It gives Intel a structural cost advantage that is incredibly difficult for overseas competitors to match without massive state subsidies of their own.
Right, but there's a caveat, right?
There is, which Zinsner accurately pointed out, and that's the timing of the cash flows. You have to lay out the gross capital up front, build the facility, reach production readiness, file the compliance paperwork with the IRS, and then you receive the credit.
So it creates a short-term pressure cooker on free cash flow.
Yes, but the long-term unit economics are phenomenal.
Yet, even with a 35% discount, the Field of Dreams strategy, if you build it, they will come, has historically bankrupted semiconductor companies.
Oh, many times.
How do we know there will actually be demand for these factories when they come online in 2027 and 2028?
Because they aren't building on speculation. CEO Lipu Tan has instituted a brutal operating discipline regarding capital allocation.
Okay.
Zinsner made it clear that they're only authorizing the massive step-ups in tooling spend, like buying those $300 million high-NA EUV lithography machines, because they have locked-in long-term agreements from external customers.
Wait, they have prepays. Hyperscalers are literally giving Intel cash upfront today to guarantee their place in the manufacturing line 2 years from now.
Yes, they are. The capacity for advanced nodes like 18A and the upcoming 14A is viewed as a strategic national asset. Major technology companies cannot risk being locked out of the supply chain.
So they reap massive prepayments to Intel Foundry to reserve cleanroom space and wafer starts.
Exactly. When you have a signed contract and cash in hand from a trillion-dollar cloud provider, you de-risk the CapEx build-out. You are merely executing against a committed backlog.
And a huge portion of that committed CapEx isn't just for front-end wafer fabrication. It loops right back to the bottleneck we discussed earlier.
The packaging.
Yeah, they are funneling billions into expanding their back-end advanced packaging facilities. They have to build out the EMIBT capacity to ensure they can actually package all the silicon they are printing.
Absolutely.
So to bring this massive macroeconomic picture down to earth, what does this actually mean for you, the retail investor holding or considering INTC? Let's get to part 4. The bottom line.
If we synthesize the margin expansion, the data center growth, the factory yields, and the de-risked CapEx strategy, I take a very strong, opinionated stance here. This quarter is a profound bullish signal for Intel.
A bullish signal.
Yeah. The execution risk that plagued the company for the last 5 years is rapidly evaporating.
But the bears will argue that Intel is still losing socket share to ARM-based processors. You look at hyperscalers like Amazon and Microsoft, they are spending billions designing their own custom silicon accelerators based on the ARM instruction set.
Which completely bypasses standard Intel by 86 architecture.
Right. So if the future of the cloud is custom silicon, isn't Intel's core CPU business in terminal decline?
That bare thesis completely misunderstands Intel's modern business model. It assumes Intel is fighting a zero-sum war against ARM.
Or are they not?
The reality is that ARM is no longer an enemy. They are one of Intel's most vital partners. And this brings us to the biggest sleeper hit inside this earnings report, Intel's ASIC business.
ASICs stands for Application-Specific Integrated Circuit. This is custom silicon. Explain the economics of an ASIC for the listener and why a hyperscaler wants one instead of just buying an off-the-shelf GPU from NVIDIA or a standard CPU from Intel.
Sure. An off-the-shelf processor is a generalist. It is designed to be reasonably good at everything, from running a web server to compiling code to rendering video.
Jack of all trades.
Exactly. But if you are a cloud provider running a massive specific AI workload 24 hours a day, a generalist processor wastes incredible amounts of power and silicon space on features you just don't need.
Right.
An ASIC is custom designed to do one specific mathematical operation with ruthless efficiency.
So Amazon builds an ASIC specifically optimized to run their proprietary machine learning recommendation engine. It does nothing else, but it does that one thing 10 times faster using half the electricity.
Exactly. And most of these cloud providers are basing their ASIC designs on ARM architecture. 5 years ago, Intel would have viewed this as a lost sale.
But today,
Intel Foundry steps in and says, we see you want to build a custom ARM chip. We have the most advanced packaging technology in the world, we have the most advanced substrate supply chain, and we have a library of proprietary IP blocks, like memory controllers and high-speed SerDes interfaces that you can drop directly into your design.
So Intel is essentially acting as the ultimate high-end general contractor for custom silicon.
Yes.
Even if the customer chooses an ARM processing core over an Intel core, Intel still gets paid to provide the critical IP blocks, manufacture the physical silicon wafer, and package the final chiplet architecture together using EMIB.
It is a brilliant heads I win, tails you lose strategic pivot. And the financial scale of this ASIC division is shocking.
Tell us about the numbers there.
During the Q&A, Zinsner confirmed that the custom silicon business is already approaching a $2 billion run rate, with a highly visible path to a $4 billion run rate in the near term.
$4 billion.
Yeah. Furthermore, Lipu Tan estimates the total addressable market for these custom ASIC data center solutions to be $100 billion.
A $4 billion, highly profitable run rate for a business unit that most retail investors barely even know exists inside Intel.
It's wild.
The narrative is so entirely focused on the desktop CPU wars that Wall Street is completely mispricing a $4 billion custom foundry business growing at double digits.
And the custom business is what drives the confidence in the future factory nodes. Lipu Tan noted that defect density and transistor performance for their next generation 14A node are actually outpacing the development timeline of 18A.
Oh, wow.
Yeah, they have completed the 0.5 process design kit, or PDK, and the critical 0.9 PDK is on track for release to customers in October.
Let's clarify why a PDK matters, because that is a highly technical milestone that directly impacts future revenue.
A PDK is essentially the instruction manual and software simulation kit that external customers need to design their chips for a specific factory.
Okay, so they need that before they can even start designing.
Exactly. When you design a chip, you have to know the exact physical characteristics of the factory that will print it, how the wires behave, the resistance of the materials, the microscopic design rules.
So when Intel releases the 0.9 PDK for the 14A node in October, it allows major tech companies to finalize their chip designs and commit billions of dollars in future manufacturing contracts to Intel.
Right. Lipu Tan explicitly stated they have committed to a high-volume ramp of the 14A node in 2028 entirely because of the intense customer engagement and prepayments they are securing right now.
So, synthesizing all of this into actionable advice, if you are currently holding INTC, this quarter validates the turnaround thesis. The manufacturing yields are fixed, the operating leverage is generating massive cash flow, and they're successfully capitalizing on the AI data center boom.
Absolutely.
And if you are considering buying the stock, the strategy is to look completely past the expected PC market weakness in the back half of the year. Do not get shaken out by cyclical memory pricing issues affecting laptops.
Yeah, focus instead on the 59% server growth, the $4 billion path for the custom ASIC business, and the structural advantage of a fully funded, US-backed advanced foundry.
Intel has positioned itself as the only company in the world that can design a general-purpose processor, help you design a custom ASIC, manufacture the raw silicon, and package it all together with advanced substrates under one roof.
The moat they are building is incredibly wide and fiercely capital intensive. If they continue executing on the physical factory buildouts over the next 18 months, the compounding revenue from these long-term foundry contracts will fundamentally redefine the valuation of the company.
We have covered the macro demand, the factory yields, the massive CapEx, and the custom silicon sleeper hit. But before we wrap up this deep dive, there was one tiny detail buried at the very end of the analyst Q&A session that listeners really need to mull over.
Oh yeah, the read between the lines moment.
It is a classic read between the lines moment that points to where the entire industry is heading in 5 years.
I suspect you are looking at the exchange with Aaron Rakers at Wells Fargo regarding memory architecture.
Yes. Aaron asks this incredibly dense, highly technical question about future memory architectures, specifically probing about new technologies like entangled memory and 3D stacking.
Right.
And CEO Lipu Tan, in the middle of giving a very standard answer about packaging, casually drops a bombshell. He notes that because memory is the ultimate bottleneck in AI, Intel recently hired Shoki Lee to join their executive team.
And for the listener, Shoki Lee is the former CEO of SK Hynix.
which is huge.
SK Hynix is one of the three largest, most dominant memory manufacturers on the planet. They are the undisputed leaders in high bandwidth memory for AI.
Exactly. Why on earth does the former CEO of a memory manufacturing giant quietly take a job at Intel, a compute company that famously exited the memory business a few years ago when they sold their NAND division?
You don't hire the CEO of SK Hynix just to manage external purchase orders.
No, you don't. If you connect the dots with the advanced packaging roadmap, it points to a radical shift in computer science. Okay, tell me more.
Throughout this entire deep dive, we've discussed how moving data between the logic processor and the external memory is the biggest bottleneck in AI. It consumes too much power, creates too much heat, and takes too much time. This is known as the von Neumann bottleneck.
Because the processor is always waiting for the memory to hand it the next piece of data.
Right. Lipu Tan stated on the call that Intel is aggressively looking at areas where they can integrate compute and memory using advanced 3D stacking.
Wow.
By bringing in Shuki Lee, Intel is quietly signaling that they are working on revolutionary ways to physically fuse logic transistors and memory cells together within their AMD packaging facilities.
They aren't going to start manufacturing raw memory chips again to compete with Samsung or Micron, but they are absolutely trying to figure out how to stack memory directly on top of the CPU core at a microscopic level. What if Intel's ultimate ace in the hole for the AI wars isn't just building a faster processor or scaling a smaller transistor node? What if their master plan is to completely reinvent the physical architecture of how memory and compute interact?
It would change everything.
If they solve the physics problem of 3D memory integration, they break the von Neumann bottleneck. And if they hold the patents and the packaging capacity for that technology, every AI data center in the world will have no choice but to buy their complete packaged solutions, regardless of whose logo is stamped on the silicon logic core.
It is a profound engineering challenge. Integrating high-density memory directly onto a logic die creates massive thermal management issues. I mean, the chip could literally melt itself.
Right.
But they're clearly assembling the executive talent, allocating the R&D capital, and building the physical packaging fabs to attempt it. It is an area of deep technological convergence that investors must track closely over the next 24 months, because whoever solves that integration problem owns the next decade of AI infrastructure.
It is a multi-billion-dollar physics problem, and they are attacking it head-on. Remember how we started this deep dive, talking about corporate turnarounds being like steering an aircraft carrier in a bathtub?
Yeah.
Well, the Q2 2026 earnings call makes the reality explicitly clear. Intel isn't just slowly turning the ship, they are entirely rebuilding the nuclear reactor while redlining the throttle in open water.
Well said.
The diagnostic surface of this company's future might still have some ripples from the cyclical PC market, but the underlying current of AI infrastructure and custom foundry execution is moving with massive, undeniable force. Thank you for joining us for this high-speed Talk Tickers Deep Dive. As always, look past the headlines, dig relentlessly into the data, and stay insanely curious.